no attendees waiting. We can start it now. So before we start today's session, as always, I want to, just a little give a brief introduction about PACE and what we do, and then we will move on to the topic. So many of you may know, you may already know me. If not, my name is Vartuhi Andreasyan. I am a business counseling manager at PACE Business Development Center. So first of all, I would like to express my sincere gratitude for your time today that you are joining, this session. And I also want to thank CitiBank and Saloni for their time and resources they provide and their collaboration. So before we begin the workshop again, I will give you a little brief of who we are. So PACE, the name comes from Pacific Asian Consortium in Employment, and we are a nonprofit organization who mainly the focus is for the community development. At PACE, we have different departments. We have education, we have workforce, we have energy department, and of course, PACE Business Development Center. Our work is addressing different areas and different needs of the community. So at PACE Business Development Center, we have 3 different categories of services. We have counseling, procurement, and access to capital. So under counseling, we work with the business owners, those who want to be a business owner with different needs. It could be business license, DBA, business plan, cash flow projections. So many more things could be there that we can help the business owners or those who want to start a business. We can work with them. When it comes to the procurement, we help the business owner to navigate through the system to understand how it works, how the procurement process works, to understand the certification process, capability statement, to navigate through the RFPs, RFQs, and how to write a proposal. And of course, when it comes to the access to capital, we support the businesses who may not necessarily, have the access to the conventional banking system resources. So PACE is a certified CDFI. We are a resource for SBA micro lending. We are an iBank lender, EDA lender. Just to let you know, we all are aware about the disaster which is going in LA County and the wildfires. So to help and assist our small business community, PACE developed a disaster express loan program. I will share the flyer with you guys. This is mainly to address the immediate needs of the business owners to pay some bills, some operation expenses. I will share the flyer with you. If you have any question, please feel free to ask us, if there is anything that we need to clarify. Otherwise, this is designed to be fast. Within 3 days, business days actually, we want to review these cases. And within, another 2 days, we want to release the funds to those who are in need. I want to mention that our partnership with CitiBank has been instrumental in providing valuable resources to the small businesses and the small business community. We are grateful to CitiBank and Annabelle is not here, but we are really grateful to CitiBanks and the resources they provide, and of course grateful to Saloni that she volunteers to do this workshop for us. So Saloni is a professional. She's an analyst in healthcare corporate banking. She will talk more about her background. I don't want to take it, she will do that part. And we will have a Q&A session at the end. Please, if you have any questions, feel free to write them down. Saloni may have pauses during the workshop. If you have questions during those pauses, you can, write your question and we can address them. Otherwise, definitely we will have a Q&A session at the end and we can address your questions at the end. So without any further ado, I want to invite Saloni to start her workshop. Thank you, everyone.
Amazing. Thanks, Bertuhi, so much for the introduction. It's been a pleasure kind of partnering with Pace for over the past year and just having these sessions super helpful. But a little bit background about myself. Obviously, my name's Saloni. I've been working at Citi for about a year and 6 months now. Before Citi, I graduated from the University of Miami and I studied finance and accounting. Did my internship here in healthcare corporate banking, kind of focusing on a lot of credit work and underwriting, and then eventually turning into full-time position for all of our global healthcare corporate clients. But super excited for the session today, where I just be kind of focusing on building credit and kind of talking through a little bit about differences between personal and business credit. But I'll quickly share my screen. And of course, I want this to be as interactive as possible. So feel free to kind of stop me as you may seem fit. If you have any questions, if you want to add anything, happy to kind of tweak it the way you want it to be. But let me know if you're able to see my screen.
Yes.
Perfect. So, just a little bit on the layout for today's session would just be kind of going over 5 different sections. A kind of just the big picture on credit reporting and what you should be thinking about as your business, the impact of personal credit on business, kind of how the business credit reporting works and how lenders kind of think about evaluating your credit worthiness, and eventually going into credit reporting and business operations. And I hope that at the end of this session, you kind of understand how the personal and business credit reporting landscape relates to your business, identifying what goes into both of those buckets, and also kind of establishing and building strong personal and business credit histories. Um, and just really understanding at the end of the day, like what is it that lenders are kind of looking towards and what others may use your business and personal credit information. And lastly, I think I will also kind of touch a little bit on how credit reporting services may benefit your businesses, leveraging any strong personal and business credit histories for um, in order to kind of achieve those better financing terms, and also at the end of the day, recognizing when business credit history may become a better and a bigger factor in accessing financing. Um, so I'll kind of throw this out to the audience, but what is it that you kind of currently know? Anything else that you want to specifically learn from? Feel free to kind of unmute yourself or raise your hand, but I'll pause here for like 5 to 7 seconds before I start into the first section.
Everyone, you can use the chat box to write your comments, or if you would like to speak, you can raise your hand and I can unmute you.
Well, okay, so I'll dive into the first section now. That really talks about like why are credit reporting agencies important to my business, right? And even before I go into that, I think let's just talk about credit in general. I think it's a very essential financial tool that kind of allows individuals and businesses to borrow money or access goods and services with the promise of repayment in the future, right? And the way I like to think about it is it's a measure of trust and reliability in managing financial obligations. So for small businesses, especially, establishing and maintaining good credit is fundamental for sustaining operations, expanding, or even just weathering financial challenges. And building credit involves kind of responsibly managing credit accounts, making those timely payments, and demonstrating a consistent ability to repay debts. And on the flip side, obviously, poor credit can limit access to financing, also at the same time increase borrowing costs, and at the end of the day, hinder growth opportunities. So, simple example of this, let's say you own a small bakery, and if you consistently pay your suppliers on time and keep your debt under control, it's going to build obviously a strong reputation, and it just makes it easier for lenders to lend money to you to kind of agree and negotiate on the financial terms that you're comfortable with, etc. So diving a little bit deeper into why credit reporting agencies are important. So they do play a pivotal role in the financial ecosystem, and they provide valuable information about individuals and businesses' creditworthiness, right? And these agencies kind of sit in a position where they will gather data from various sources, whether that's banks, whether that's credit card companies, or even just lenders, to kind of compile these comprehensive credit reports. And what these reports do is they have details about an entity's borrowing and repayment history, any outstanding debt, or even just like kind of tracking those financial behaviors. And that's why for small businesses, credit reporting agencies, they serve as like a centralized source of information that lenders use to kind of assess the credit risk when they're considering the loan applications that you submit. And by accessing these data, lenders can kind of make informed decisions about extending credit, determining any interest rates, and eventually setting terms and conditions. So that's kind of why we talk about like why credit reporting agencies are important to my business when you're taking that first stance and like, why does this even matter? We kind of touched on like what the definition of credit is, and then let's now kind of move into personal versus business. So distinguishing between personal and business credit history is essential for small business owners, right? Like personal pertains to an individual's financial activities, including any of your personal loans, credit cards, or mortgage payments. Versus business credit history, on the other hand, focuses on the financial performance and obligations of the business entity itself. So while personal credit can influence business creditworthiness, establishing a separate business credit is crucial for protecting any of your personal assets and fostering the growth of your business. And building strong business credit involves also like opening accounts in the company's name, making payments in time, and maintaining a positive financial record. So you'll kind of see how these both go hand in hand, but that's how I would kind of differentiate the two between why both of them are important, and it's also important to kind of keep them separate. Um, and here's kind of why you will see like a little cycle or like a snapshot of why the importance of credit is so crucial for your business. And the first is obviously access financing, right? Like before you're even considering either starting your business, the first thing that gets your mind is where am I going to get the capital from? And you get capital, right, based on your credit and based on your historical performance. And the next thing you would kind of go on to thinking about is either acquiring or like manufacturing inventory. So purchase it and eventually start managing your working capital, right? So you'll see how this kind of gets looped into like a cycle. And as any small business, a business needs cash or working capital to kind of cover its daily operations, such as any sort of payroll, rent, inventory, etc. So this is why the fundamentals of credit are so important when you're kind of working through that cycle of your business, whether it's the first stage when you're just looking for financing, or if you're looking to kind of manufacture that inventory, to then kind of eventually thinking about buying those equipments, materials, and then going on to the final stage of like, how are you going to actually manage those daily operations? Um, so the next slide kind of talks about, and I'll take a pause here before actually go into the spectrum of how the balance between the importance of personal versus business lies, but I'll just take a pause here for a quick 5 seconds to see if anyone has any questions so far. All right, sounds good. I'll keep on moving, but essentially, as I mentioned before, that yes, personal and business credit, it's important to kind of have them separate. to some extent, they do influence each other, right? And before you have your business established, your personal credit matters a lot because that's what the lenders are focused on. If you do have a positive, strong track record of your personal credit, it becomes a lot easier for the lender to kind of assess what's needed for your business credit. And then as you eventually aim at growing your business, the business credit becomes a lot more important. So you'll see kind of the spectrum here, which kind of talks about like the age / the growth of your business. So if you're a very large, sophisticated business that may not need to rely on personal history, right? Because at that point, you've kind of consistently proven to the lenders or whoever it is that you're getting that financing from that you do have a very stable track record of kind of maintaining and paying those timely payments back. So they will not rely so much on your personal credit history versus someone who's like probably just starting out as an aspiring entrepreneur, your only fundamental base that they can look at or your only historicals that they can look at is your personal credit. So that's why like it really depends on the age and growth of like where your business sits to determine the importance of like which bucket or which kind of like stage of your business, what type of credit becomes more important. But the next thing I want to talk about is just kind of throwing out some questions, right? Like, have you applied for business loans or any lines of credits in the past? Like, what information, documentation did the lender obtain? And did the lender tell you if he or she would need to check her credit history, etc.? So this is like a great segue to kind of move into our second section of the impact of personal credit on your business. And that's when I'll dive a little bit deeper into the personal credit report, right? So this is kind of a report where if I'm a lender to your business, it really tells me like who you are, how much your current debt is, and for how long have you had it, because that kind of gives me a picture of if you've had this debt for so long, why have you not been making payments, have been making payments, etc., and how frequently have you kind of applied for credit. And if you have applied for credit, how much of the credit are you using, to kind of then see like, okay, whether you're making timely payments or any late payments on your credit accounts. And then lastly, if there's any kind of information from your personal credit report that might kind of give me a signal towards any negative information that might relate to bankruptcies or foreclosures, etc. Because as a lender, these are kind of like the main, I would say, pointers that I would look at when I'm kind of evaluating someone's personal credit record. But before I go into that, let me just kind of also expand that applying for like a business loan or a line of credit is a significant step for any small business owner, and lenders typically require all the documentation and kind of like the things that we touched on to assess whether for them the borrower is creditworthy or not, right? And sometimes when you think about business credit reports, you'll see that they will ask for a little bit more different documentation than what's needed for a personal one, right? So for business, they might ask for what's the business plan. So a detailed business plan kind of outlining your business model, market analysis, products or services, and financial projections. And this kind of helps the lenders understand your business strategy and what kind of your goals are in terms of future profitability. B could be financial statements. So a profit and loss statement, like a simple one showing your business's revenues, expenses, and profits over a specific period. Balance sheet kind of showing a snapshot of your assets, liabilities, and equity at a particular point in time. And even just a cash flow statement, kind of showing the inflow and outflow of cash within your business, demonstrating how effective you are in managing your cash effectively. And then some other things that I'll kind of skim on, but can touch a little bit in more detail once we go further into the presentation, could be tax returns, right? So if you're obviously an aspiring entrepreneur with a smaller business, this might mean your personal tax returns for the past 2 to 3 years. And these documents kind of provide a historical record of your earnings and tax obligations. You also have your credit reports. So lenders will check your personal credit history to evaluate your reliability as a borrower. And this includes your personal credit score, payment history, outstanding debts, any derogatory marks. So this is how you kind of see how the impact of personal credit on your business is significant, especially when you're trying to like grow your business. Um, Other things that they might ask for that come to my head are bank statements. So recent bank statements, typically the past 6 months or 12 months for both your personal and business accounts, depending on the cycle of your business that you're currently in. Any legal docs that might mean any business licenses, proof that your business is legally registered and authorized to kind of operate. So when you do make your own like LLC, corporation, etc., you'll have your articles of incorporation or organization based on the state that you register your business in. And these documents kind of outline the legal structure of your business, and would also potentially show like any lease agreements, um, if applicable, to also show your business premises are secured or not. If you are applying for, say, a secured loan, you may have to provide information about your collateral, such as any real estate, equipment, inventory, which the lender can kind of claim if you default on the loan. Um, so when you do have these initial conversations with the lender, you will discuss your financing needs and the type of loan or the credit line you're seeking. And the lender will then kind of provide an overview of the application process and the required documentation, right? So this is just kind of how it it kind of flows with like what's needed in your personal credit report versus what's needed in your business credit report, and kind of how they differ based on what cycle of the business you're in. That brings me to our credit reporting agencies. So as I mentioned earlier, these agencies kind of track and gather data from um, each of the borrowers to kind of use these data to provide any information, or just have all these informations to assess the trust and reliability of how good you're managing your financial obligations. And that's why it becomes, just to reiterate, maintaining and establishing that good credit becomes super handy when it comes to what these reporting agencies are gathering. So when we think about the major consumer credit reporting agencies, you have your Equifax, Experian, and TransUnion. And these are kind of known as like the credit bureaus, and they're the key players in the credit system, and they maintain consumer credit information, right? So Equifax, just a quick, I'll just kind of go over like why there's three, like any differences, etc. But Equifax, founded like a while ago, one of the oldest and largest credit reporting agencies. It does provide exactly what I said: credit reports, any credit scores, and credit monitoring services to both consumers and businesses. Um, so it will gather credit data from various sources, which could mean any lenders, any banks, any public records. And this data includes payment history, credit utilization, what's the length of your credit history, and more. And sometimes, like, I think they also offer identity theft protection services and a range of other business credit services, including a lot of like the risk management tools as well. Experian as well, a very old global credit reporting agencies that kind of operates in multiple countries, and it offers credit information and analytical tools to kind of help businesses manage credit risk and prevent any type of fraud. Same thing as Equifax collects details on your payment history, credit inquiries, any etc., to kind of calculate what your credit score is going to be and to kind of create those credit reports. And similar to what Equifax does, you do have the option for identity theft protection, any personal management tools, risk management tools, etc. It also offers business solutions, including any like marketing services and data analytics. So that's kind of how those two agencies kind of play a role. And then the third one you have is TransUnion, that I'm pretty sure all the three agencies you would have heard a lot, but it's also one of the leading credit reporting agencies that kind of provides credit information and risk management services to both consumers and businesses. In the grand scheme of things, like these agencies, they impact consumers and businesses, right? So the credit reports that I talked about, these agencies will provide a detailed report, and that will summarize everything that's kind of happened in your credit history past, like any information, including credit inquiries, public records, etc., and just alerting consumers to potential fraud or identity theft. So you also have the option for, I'll kind of flip the pages here, but we talked about how these are the information needed in personal credit report. And one thing that I do want to touch on before we move ahead is obviously talked about what's needed in the information. So what you'll see typically is your name, social security, date of birth, telephone number, and some of the other things that are listed here. But one thing to keep in mind is that these are things that will never appear on the personal credit report, which is your checking and saving account balances, any race, gender, religion, marital status, purchases made with cash, check. That's not something that will ever be a part of a personal credit report. So just something to kind of keep in mind when you look towards kind of like analyzing what's included and what's not. So let's go ahead and move on to what a personal credit score is. So the way I like to think about it is kind of just assigning someone a number based on like what your past credit history has been. And that's essentially what a personal credit score is. And you know, whether it's like 750, 685, and obviously the higher your credit score, the better it is for you to kind of access that financing at a favorable and affordable financial term that kind of aligns with what you're looking for. So that's something to keep in mind. And it does vary from, I would say, 300 to 850, with obviously, if you have like a 800, that obviously means like a better credit score. And when you talk about the score models, the most commonly used are FICO and VantageScore, and these are literally based on your credit report, which includes the payment history, what is the amount that you owe, the length of your credit history, new credit, and the types of credit used. So it really depends on, I will flip the page here to like see what is it that really affects the score, right? So the way these score models work is they assign a certain type of percentage and weight to each of the categories. So for example, obviously, if you look here for FICO, the past payment history is 35% weight, which means that that is something that they take into account a lot and is something that they focus on a lot. So consistently paying your bills on time positively impacts your score, right? If you do miss a payment or if you make late payments, that can kind of significantly lower your score, and you'll kind of see that if you go through one of those experiences. And severe delinquencies, obviously, such as any defaults or bankruptcies, they could have a substantial negative impact. Amounts owed, right? Like any outstanding debt also kind of stands on like the higher end of the hierarchy, where this ratio kind of compares your current credit balances to your total credit limits. And keeping your credit utilization below 30% is generally considered good. And high balances on any of your credit accounts can kind of negatively affect your score, because it's kind of saying that you do have the limit to spend this much, but you're also utilizing a lot, which kind of puts the lender in a bit of a hesitancy to see if you would be able to pay that much debt back. Length of the credit history, also important, takes about 15% of the wage. So the longer your credit history, the better, as it provides more data on your borrowing behavior. And the average age of all your accounts also matters. So if you're kind of opening a lot of accounts in like a span of like every 2 months, that kind of shows us like a little bit of a red flag versus you kind of maintaining an average age on all your accounts to show that there's a little bit of reliability here. New applications for credit, recent inquiries. This is kind of applying for a new credit card, and that can result in like hard inquiries, right? Which may temporarily lower your score, which is why sometimes when you do open a new credit card account or a credit card, like you will see that it does affect your score negatively. At the same time, also opening multiple accounts in a short period of time can also be considered risky. And then lastly, it's types of credit. So having a variety of credit types. So what I mean by that is credit cards or mortgages or auto loans that can kind of positively influence your score, as that shows that you're responsible and you do have the ability to kind of manage your different types of credit responsibly. And to kind of go into the Vantage score model, that's kind of a model that was jointly developed by the credit rating agencies that we talked about earlier, so Equifax, Experian, and TransUnion. And kind of just a little bit of concise summary, it was introduced in 2006 as an alternative to like FICO that we just talked about. Again, ranges from 300 to 850, just like how FICO does, with higher scores indicating better creditworthiness. And it also does look at a lot of the same kind of criteria as you see in terms of what your scoring is dependent on. And then periodically updated to reflect changes in consumer credit behavior, right? Like they go through these different versions. I think there's one called the Vantage Score 4.0, which kind of shows a more recent scoring model based on what the consumer behavior has recently been. We also have our usage, so increasingly used by lenders, especially for consumers with limited credit histories. It's also used for educational purposes and any credit monitoring services. And then lastly, I would say accessibility. Consumers can access their Vantage score credit scores through various channels, including like any of the financial institutions or any credit monitoring services, etc. I think the benefit here is that it benefits consumers with limited credit histories. Scoring is also consistent across the three major credit bureaus. And then also it provides tools to help kind of consumers understand how and what are the ways for them to improve their credit score. And we kind of talked about this very simple scale to kind of depict if you are on the higher spectrum, that will obviously mean that you're less risky, people are willing to lend that financing to you, and it's eligible for the best rates and terms and credit products, as in they will kind of negotiate to give you that lower interest rate, which you might not have if you're on the poor credit spectrum, kind of signaling high risky and more likely to be denied credit. And even if you are approved for the credit, you might end up paying higher rates. I will stop right here to see if you guys have any questions for 5 seconds, or I'll keep going.
Again, if anyone wants to talk, you can ask and I can unmute you. There's a question. How to search reliability of companies who help with too many credit card debt, and it's called hardship relief.
Sorry, Huberto, you cut off in the end. Is it in the chat?
Yes, the question is how to search reliability of companies who help with too many credit card debt, and it's called hardship relief.
It's called what again?
Hardship relief.
Hardship relief. So
Yes.
just so that I understand, is it that how to search or how to kind of understand reliability of companies dealing with a lot of credit?
There are companies, seems that they are offering credit card debt relief. So, which is like called under hardship relief, they do this. So the like attendee is asking, are they reliable?
Okay. So on your question regarding that, I think when evaluating the reliability of companies offering credit, sorry, I like couldn't hear the last part, but offering credit hardship relief or like kind of credit card relief, I think it's important to approach the research methodically. And what I would say is kind of checking if the company is accredited by recognized organizations like um, Financial Counseling Association of America, or if they're accredited by the National Foundation for Credit Counseling. So I think that's the first step to see if they do have the accreditation and license to do that. Um, and also just looking up licenses with like state regulatory agencies to ensure that they're legally permitted to operate in your state. I think the other thing that I would say is researching complaints and reviews. So I'm pretty sure just as if you go on like any shopping website, you'll see kind of people post reviews about products. That's how I would approach this. Read those customer reviews on websites like Trustpilot or even Consumer Affairs to assess the company's reputation. Or even just like ratings and see how they've kind of handled customer complaints. And then third, I would say confirm their nonprofit status if it's applicable. So many legitimate credit relief organizations, they operate as nonprofits, if I'm not mistaken. So use the IRS exempt organizations search to verify their tax exempt status. Um, I think other than that, investigating their practices, I would say, would be the other thing. So companies that promise to kind of settle your debt for pennies on the dollar or guaranteed results, like verify if they provide written agreements detailing any sort of like fees, services, and timeframes. And then ask some key questions like, are they transparent about their fees? Do they offer any, I guess, free consultations before signing a contract? Are they willing to provide references or a list of satisfied clients? I think those are some of the key questions. And then lastly, I would just kind of check their website and contact details to see if the website has like a professional appearance, provides clear contact information, looking for any types of disclaimers, privacy policies, and details about their services. And I think some of the red flags that I would look for would be a upfront fees. So legitimate companies, they will usually not charge fees before providing services. B would be lack of transparency. So avoid companies that do not provide any detailed terms in writing. Um, Three, I would put maybe unrealistic promises. So be cautious of guarantees to eliminate all debt or drastically lower your credit card payments. Like obviously that should kind of be at your own discretion to figure out like, okay, if they're offering so much relief, like there should be kind of like a catch associated with it. So just kind of um, evaluating that, and then very basic, but legitimate firms will allow you time to review and decide without like any sort of pressure. But I don't know if that kind of answered your question, but hopefully that helps.
Thank you, Saloni. I think you pointed out many critical information that it's important, especially to check if you are going to pay any fees, and there is a contract. Read your contracts and
Yeah.
understand what they're offering against your contracts. So to be clear, what is the expectation and what you are paying for, because many they may like offer in verbally, they may mention in their marketing to different services, but when they put the contract, they don't write it in their contract. So the contract is very general. So make sure you read your contract, you understand what is like if it is covering all the expectations you have, and then you know, if you are paying any fees, then you do that. Otherwise, just be careful. And I just shared a link for the there's a organization who helps with those who needs assistance with the credit card debt. So we can contact this organization, and you can see if you can get, you know, some assistance from them if it's a credit card debt. Okay. And there is another question asking, is it could let me see, is it affecting the credit score if they are checking it frequently?
Checking what frequently again?
If they are checking, does it have a negative impact if you check your credit score frequently?
I don't think
I don't
so. I
know.
don't think that has any kind of correlation. It's kind of at your discretion to see and be up to date with your credit score. So I would say no, there's no kind of negative impact for you to check your credit scores frequently.
Yes, yes, that there is no like relationship in that, unless there's an hard inquiry, which is like, then definitely there will be an impact.
Yeah, exactly. Like hard
Yes.
inquiries, like for those, like just when a lender kind of checks your credit as part of like a lending decision, such as like applying for a credit card mortgage loan, that's when you'll kind of see it be affected. But usually when it should not affect if you're just checking it frequently for your own benefit.
Yes. And Saloni, my understanding is now your transition is toward the business credit. Am I correct?
Yes.
Okay, so there are questions about the business credit. So we will not address those questions now because you are now moving toward that, you know, area. So
Yeah.
I'm pretty sure you will address all those questions.
Yeah.
If by the end of this session you will not get the answer to those questions you wrote about the business credit, then you can, you know, raise those questions again. And yes, this session is being recorded, and you can always access to these recordings through our e-library. Okay, then.
Okay. Um, that makes sense. I'll kind of skip just the one last point that I wanted to touch on here is that if you do have the ability to kind of request that one free personal credit report every 12 months from each of the three agencies, but I'll keep this brief. If you ever needed the copies to kind of, you know, dispute anything that you see in the credit report, request a new one if you're not kind of like sure of, but it's always just important to make sure that it's accurate and it reflects what you kind of have outstanding and what it is based on like what you're trying to prove. But just something to kind of keep in mind. And these are just kind of the two like laws that were put into place that kind of shows the Fair Credit Reporting Act and the Fair and Accurate Credit Transaction Act. But that's kind of sums up our information on like regulations for personal credit bureau reporting and your rights as a consumer slash a business to kind of, you know, see that personal credit report, like make sure that they're accurate, and your rights to kind of dispute that information on your personal credit that you judge to be incorrect. And all kind of just some best practices that we can kind of touch on later, but we'll kind of now move on to business credit. But let me just perfect. So we kind of touched on this, so not gonna kind of go over it again, but as we saw that they do go hand in hand and it's important to have them separate, but at some point of time in your business, one becomes influential on the other. So just something to keep in mind. But the major players here are Dun& Bradstreet, global leader in business credit reporting services since like a long time. They offer business credit report scores, analytics, just very similar to how Equifax, Experian, and TransUnion offer for personal credit reports. It also helps businesses kind of assess credit risk and make any like informed decision. Equifax, similar to how we talked about earlier, extensive database with diverse data sources helps kind of businesses manage credit risk and protect against any sort of bad debt. And then lastly, we have Experian, which kind of provides those innovative business credit reporting solutions, any harnesses advanced like analytics and alternative data sources, and then lastly just empowers businesses with kind of actionable insights for you as a business entrepreneur to make smarter credit decisions. Um, and this is kind of the discrepancy of like what we kind of talked about earlier of what information goes into business reports. It's very similar to obviously what goes into personal credit report. The difference being here, you kind of have to prove when your LLC was established, your articles of incorporation to kind of show the legal org structure, whether it's an LLC, whether it's a S corp, C corp, etc. Um, and any sort of business background. So history of any business affiliations, any corporate financial reports, any self-reported data, and then kind of going into any sort of negative reflection that the lender might get out of your business credit report that might highlight um, any lawsuits, liens, bankruptcies, foreclosures, any kind of red flags that might need to be addressed or would have to be kind of shown in the report. Um, and a lot of the regulations that we talked about earlier, they don't really apply to business credit reporting. So the FCRA that I mentioned earlier, that doesn't apply here. And then they still have some procedures in place where you do have the right as a business to kind of make sure that your credit report that they're putting out, that the agencies have, is accurate. And in the event that you do see any kind of mishaps, you have the ability to kind of dispute that, and just kind of making sure that everything on there is speaks to you and your business. But this kind of shows like a little bit of difference between personal and business credit score. Very similar, not going to talk a lot about diving deep because I'm pretty sure you guys are very well versed with it. But this is when I said that, it's those regulations don't apply, but you still have the ability when you make an account on Dun& Bradstreet to kind of access your credit report. They also kind of use credit monitoring services to receive any alerts and check business credit scores. So some could have charges associated with it, and some might be like free services. And this just kind of goes on to like why you should even think of establishing one if you are someone who's considering whether I need it or don't need it. But I would say just provides valuable insights into your business entity, and it's used by creditors, it's used by suppliers and other stakeholders to assess the risk and make informed decisions. And when you do have those like company name, your business credit score, your credit history, payment performance, public records, any business background such as industry classification, size, years in operation, um, ownership, management, financial performance, etc. That's when this becomes like really important. So for example, like even from a supplier's perspective, they may review a report to kind of determine whether to extend trade credit terms or if they want you to have like an upfront payment before they, kind of like go worthy because of like the hesitancy they have. And a positive credit report obviously helps you make those relationships and builds that strength and trust with your partners that you're working with. Um, and then lastly, I would say regulatory agencies and some of the compliance professionals, they also use these reports as part of the due diligence process to ensure compliance with regulatory requirements and kind of assess the financial stability. Um, but let's move on. So obviously before even, starting, I think just general things to keep in mind. Obviously, when you do have your LLC or type of business established, like the first thing you would request for is an employer identification number for your business. Get a copy, keep it in a safe place. See if you have your business credit report and already verify if you had one in the past, and see what the business's lenders are reporting your credit information. and ask the lenders and suppliers to kind of report information about you and any self-report financial and credit data as you seem fit. But just some best practices that I kind of touched on in the past to like you to just make sure that you're in a good standing is to obviously make sure that you have your healthy credit, the business is visible, and also maintaining suppliers and vendors. And the other thing that I would mention is establishing business credit also kind of provides a financial safety net for any unforeseen circumstances or emergencies. So it ensures your business has access to credit when needed, helping you weather any challenges or even just like unexpected opportunities that you might not have seen coming, which is why it becomes so important if you're someone in a stage who's kind of debating between whether I should have one or not. Um, I think I'll move on to the next page. So just some questions. How do you think in the next 5 years having a healthy business credit report could help your business? And maybe just like in the next year, how do you think having a healthy business credit report what's kind of like that difference between next year and like 5 years from now. So just something to think about. I'll pause here for 2 seconds if anyone wanted to kind of take a stab or just kind of share something that you would want to like even have the other people on the call know.
You got a response that it would help. And it says, gather healthy bonds with other business owners, maybe. And
Yeah.
there is another comment, more credit helps to sustain the business operations. Definitely.
Yeah, definitely. That's very true.
Yes.
But okay, that kind of brings us
I,
to like, yeah, go for it.
no, I just wanted to add that it's not only to sustain the business operation, but if anyone thinks of expansion, then they should definitely, look on the credit side and make sure that they are maintaining a good credit.
Yeah, definitely. And that's when the question really comes into play, right? Like in the next year, how does that healthy credit report kind of helps versus 5 years from now, how does it help? So I think 5 years from now, obviously you'd be at a stage when you've kind of expanded, and that's when you go back to the historical business credit report to evaluate like how positive the trajectory has been for the lender to kind of confidently be able to provide you financing at lower costs. And then it just becomes easier for you to like access that capital, like repay it using the profits you have, and it just kind of becomes that cycle that we talked about earlier.
There is a question that should you start with a business credit card if you want to like start to build up with your business credit? Is it the first step?
Should you start with a business credit card?
If like a business wants to build up the business, credit, I would say everything could be a first, step, including business credit card. But the question is, should you start with a business credit card?
I think, like you mentioned, starting with a business credit card obviously is like a first good step for like entrepreneurs and small business owners, kind of like depending on your goals and financial situation.
Mm-hmm.
Um, but and the reason it's because, a you would have a separate kind of you'll be able to separate your personal and business finances, right? Like a business will help you establish that clear boundary between personal and business, which is kind of crucial for like bookkeeping and like tax purposes. I would say if you think that business credit card isn't the best first step for you, there are other options for you to obviously like build your credit in. Some people sometimes will opt for like a business bank account, right? And that's crucial for like legal tax purposes. Um, and it will kind of help you see and handle like your income and like expenses. And you can also use like a debit card linked to this account for purchases until you're ready for a credit. So it really depends on your personal financial goals. There's not really like a wrong or like a correct answer to this. If you think that you're in a position to kind of establish that credit through like a credit card, like yes, that could be a great first step, but sometimes people also just open a business bank account, have their debit card link until you're kind of ready for the credit. Um, and I think building credit early helps establish your business's financial reputation. So applying for like a small vendor account with companies that report payments to business credit bureaus, for example, office supplies, shipping, or just paying invoices on time or early, that also kind of shows a positive credit history. Um, so maybe that's like an angle that you could consider. And sometimes I think if your business is super new and you cannot really qualify for a business credit card, using your personal card for business expenses, obviously responsibly, can still kind of help you track your spending. Um, and I've seen a lot of people just have one dedicated personal card for like business purchases and paid off in full each month to like avoid that like extra interest, and to just maintain like those good records to distinguish between personal and business expenses to then be at a point when your credit card for your business could like eventually qualify. So it really just depends on your personal financial goals.
Okay.
Hopefully that helps answer the question.
I believe so.
Okay.
As you mentioned, it's a combination of, it's not one
Yeah.
thing. They're like multiple and combination of the actions that it will help with a good business credit or personal credit, same like personal. There's one more question that I will bring it up at the end. I don't want to go back now, so let's continue.
Okay, yeah, no worries. So we're kind of approaching the last section of the presentation where we talk about like what are kind of like the current landscape of the business credit reporting, and I'll go to this which kind of has like a great graph slash a web chart that talks about like what are the 5 things if I were a lender to kind of assess if I was comfortable lending that financing and like giving access to that capital to a small business. So that really comes to like the 5 C's that we talked about. Like we talked about capacity, collateral, credit history, conditions, and character. So there's a lot of I would say, let me so obviously your credit history we talked about a lot in detail. So for example, lenders offering working capital loans, they may place significant emphasis on a business's credit history, including any sort of payment performance, credit utilization, and just like overall credit worthiness. And it demonstrates the business's ability to like manage debt and fulfill any financial obligations. So that's when it becomes important from a lender's perspective to focus on maybe credit history more than anything else. But say, for example, there's also some of the non-traditional credit data that's like very new and growing right now, where they may consider sources such as alternative payment data, bank transaction history, or even just industry-specific metrics to assess the business's financial health and repayment capacity. And I think analyzing these non-traditional data provides deeper insights into the business's cash flow, revenue stability, and any sort of operational efficiency. Um, Cash flow analysis is also, I would say, like a crucial role in underwriting working capital loans, where lenders evaluate the business's cash flow to kind of see what the projections are for the future, any sort of revenue streams, any liquidity, to be able to like generate sufficient funds to cover any of the operating expenses that you see. And I think from a lender's perspective, what also becomes important is just understanding industry and market trends. So dynamics, competitive landscape is kind of essential for assessing in determining loan eligibility and risk. So lenders may consider industry-specific factors and economic conditions that impact the business's financial performance and growth prospects. Versus if you consider a lender who's kind of providing startup loans for businesses that are just starting out, what becomes important is personal credit and collateral, right? Like they prioritize what the borrower's personal credit history has been. What are their current scores? What have their past credit scores been? What has been their payment history? And since startup businesses kind of lack that established credit history, the borrower's personal credit, it serves as like a key indicator of their financial responsibility and repayment capacity. Um, and when you are starting out or are just starting out, and you may also require collateral, excuse me, to secure the loan, especially when the borrower's business lacks like a track record or sufficient assets. And collateral kind of provides assurance to the lender and reduces the risk of loss in case of default. So that just makes them a little bit more comfortable in giving that financing. I think one thing that's also important is when loan applications are reviewed, the focus on business's viability and growth potential. So just looking at the business's borrower's business plan, what's the market research, what are kind of the revenue projections, and just kind of like a high level strategic vision to determine the likelihood of success. And repayment ability also plays an important kind of like factor that goes into this. And then I think lastly, I would say the experience, expertise, and obviously like track record of the business founder or the management team. If you have like a team for the business, they're also kind of like important considerations for lenders, and they may evaluate the founder's like industry knowledge, previous business success, and ability to execute the business plan kind of effectively. Um, so I think when we talk about what are kind of like the different things that lenders look at when they are evaluating a lot of the um, loan applications, these are the factors to keep in mind when you're kind of even doing your loan application to see from like a lender's perspective what are things that matter to them. So we talked about obviously the non-traditional data, and based on different lenders, obviously there's different priorities, as I said. Usually for startup, as I mentioned, like collateral is important, credit history is important, how much capacity you have is important. Like it all becomes very important when you're kind of new to the market, etc. And then if you're kind of working capital, like more of the non-traditional data plays a key role in that. But I think just in general, just know your rights, know your lender, and know your credit are kind of like the best three practices to keep in mind when you're kind of assessing the full spectrum of things that's needed to make sure that your business is kind of successful. And what here it is just kind of talking about like how to access those like credit reports that we talked about earlier, and they would usually pay like a fee to access the reports of consumers or other businesses. And I think it's super important because accessing these reports may be useful in kind of helping you evaluate risks when you hire employees or working with customers, clients, and other businesses. So I think that's something that falls on like accessing to credit reports. And then you have reporting to credit reporting agencies. So your small business report information, such as any sort of outstanding debt about consumers, to one or more of the major consumer business credit reporting agencies. And then it just kind of helps you support your ability to manage risk when you have a lot of transactional activity going on with your customers. But this kind of just wraps up our presentation in terms of just the differences between and just some key fundamental things to remember. Um, I think those three bullets kind of summarize it very well, of knowing your credit, just the influence of personal credit on business credit. The questions were also kind of very intriguing
Sorry,
in asking that.
excuse me,
Mhm.
Saloni, can you please move to the last, because we see the second to last. Oh, okay.
Do you see it?
You were reading the bullet points.
Do you see it?
Okay, This person, okay. I think it was my, okay. It was my mistake.
No,
Sorry.
no, no, you're totally fine. But yeah, I think just knowing your credit, like how it influences, and I think we had a question from the audience as well related to what's kind of more important. Like if I think that was a great question of like if a business credit card is kind of like the first effective step to, establish it, etc. So just knowing that, knowing your rights, that if you do see something that's not kind of accurate on your credit reports, kind of raising that, disputing that, and making sure that it's up to date at all times. Because at the end of the day, like the consumer, the business that it's going to affect the most, it's going to be you. And then, as I said, as we talked about lastly, that different types of lenders have different priorities. So just making sure um, what is it that you're kind of looking to get out of your business, like having that viability and reliability of growth potential and just market research, revenue projections to make sure that the lender feels comfortable in negotiating terms and conditions with you. Um, but yeah, I think that was it in terms of the materials. I'll take any questions now.
Um, Thank you very much, Saloni.
Mhm.
Thank you. There was a lot of information there.
Yeah.
We have questions that I wrote it down. So anyone, if you have any additional question, please write your questions. And if you want to ask your question, feel free to ask me to unmute you, and I can do so. There are three questions. The one is, can we build business credit without a business credit card? How? I think you partially answered to this question, but I think
So the question really is, can we have business credit without a business credit card?
exactly.
Yeah, of course. So yes, the answer is you can build a business credit without a business credit card. And there's several alternatives. I think registering your business, obviously, like incorporating your business or obtaining kind of like an EIN, etc., applying for any sort of like vendor account. So work with suppliers and vendors that offer kind
Mhm.
of like the net 30, net 60, or like similar payment terms. Could be one of the options. The other is taking out a small business loan or a line of credit. So applying for a loan or a credit line from like a bank or any like alternative lender, and many banks report your payment history to business credit agencies. So that's kind of how they're recording and like trapping your business credit. And then also, if your business is like super new or has no credit, secured lines or lines of credit could be like another option available for you to like build your business credit. Um, and then some business accounts also actually also kind of record your utilities, rent, or equipment leases to your credit bureau. So that's kind of one of the ways to like build your business credit. So the answer, long story short, would just be you don't need a business credit card to build your credit. There's different ways or alternative methods that you could use to build your business credit.
Yeah, thank you. The next question is asking, does business credit show up on your personal credit report? How can you prevent this?
So, sorry. So the answer to that would be, in most cases, business credit does not show on your personal credit report. And as I said, the business credit and personal credit are like two separate systems. So there are exceptions where your personal credit might be affected by your business activities. And sometimes, if you personally guarantee a business loan or a credit card or a line of credit, the lender can report the account to your personal credit business. So to Equifax, Experian, or TransUnion, as we talked about. And if the business does default on the account, the delinquency or the debt can kind of show on your personal credit report. So that could be one of the ways. The other would be many business credit cards also require a personal guarantee, meaning issuer might report the account activity to both the business and the personal credit bureau. So some cards, I think American Express may report the balance and payment history to personal credit, which could potentially affect your personal credit. Um, And I do believe that if you do operate as a sole or maybe in a general partnership, your personal and business finances are legally the same. So this means that business debts can directly affect your personal credit, if that makes sense. But if your business is structured as
Absolutely.
like a regular corporation or LLC, um, in the business is a separate legal entity, the credit activity will not appear on your personal credit report.
Again, unless, as you mentioned, they are a personal guarantee. Like
Yeah,
if you know, with PACE, if they are taking, even if they are incorporated, if they are taking a loan from PACE, we always take a personal guarantee. So it will be shown that loan will go on their personal credit.
right.
Otherwise, no. There is another question asking, this question is referring to page 32. It says it appears all the items that go into a credit report are manual and may not be automatically reported. How to make sure they are reported to a credit bureau? Can you go back to this page 32, please?
Yeah, let me just make sure. Let me share my screen again. And is this the page?
Can you please confirm if this is the page you are referring to? Alfredo, can you please confirm this is the page? Yes, this is the page.
And it says, where does it say? The question is
Uh,
that if
the question
things,
says, I don't know from why that impression is there. It appears all the items that go into a credit report are manual and may not be automatically reported. How to make sure they are reported to a credit bureau?
um, so I'm just trying to see where it says it's manual.
Uh, I again, this is not like it's not. He says it's not written there, but
Okay, but I
I
think
yeah.
generally what my take on this would be that a lot I think most of the times creditors and vendors just automatically report your payment history and account details to the business credit bureaus. So like major issuers, whether that's like Chase or Capital One, etc., they typically report to like Dun and Bradstreet, Experian, and Equifax. And if you do have, say, a loan or a line of credit, your banks and your online lenders often report payment history to the business credit bureaus. And if it's kind of like large suppliers, if you're in that stage of your business, they also frequently report kind of the payment terms like automatically. Um, so I don't think it's manual by any means. But some accounts or payment histories might need to be, from my understanding, reported manually. And I think there's services like on Dun and Bradstreet or similar programs from bureaus to kind of add non-reported data. So that could mean like either rent, utilities, or maybe some of the smaller vendors, which they might not have the ability to report that directly to your report. But I think that's
You
kind of
may
what I've seen.
You mentioned about self-reported data. Like the question is how to do that. Is there any way to do the reporting individually?
Um, for for business credit reports,
Mhm.
I I don't think it should be self-reported. Or it might actually, I think, okay, if you do want to report or self-report, I think what this page is trying to reflect is if you want to self-report to build kind of like your business credit profile, the processes typically involves like working directly with the business credit bureaus or like third-party services that allow you to add any sort of like payment history for accounts that might not automatically be captured or reported. And I think the first thing to just make sure is that your business is registered with the major credit bureaus. So Dun & Bradstreet, I think they have their own like number on their website, which is kind of required to like create a profile, and then Experian also automatically creates profile when they receive your business data. But you can kind of verify and enhance your profile, and Equifax also to some extent collects business data from lenders and public records, but you can contact them to kind of update or verify your profile. And certain services allow, I think Dun & Bradstreet has like a credit builder that lets you add trade references, for example, suppliers, rents, utilities, that's kind of considered self-reporting, which wouldn't be recorded automatically. And you would have to provide kind of proof of receipts, or like, I guess, proof of payments, which would involve like any sort of invoices, receipts for them to verify. And then I think these services also kind of have like a fee associated with them per month. I think that's how I would think about it when I like talk about self-reporting.
Mhm. And again, a part of the question was like, would supplier really report to bureau? I would say reporting comes in different ways. If a supplier has if you have a large debt and toward that supplier, and they need to, they may take different type of actions. If they want to give it to a collection agency, then definitely it could go and be reported to the bureau. So it depends on how much debt you have with the supplier. And sometimes the amount may not make sense to them, like if it's very small, to go and take the effort to do that. But if the amount is large, then they may take that path and just connect with a collection agency, give the debt to collection agency to collect it, and also do the reporting. So just be mindful of that. If they are not reporting initially, it doesn't mean that they cannot report it later. So that situation can happen. Saloni, do you want to add anything on that?
No, I think you covered that was spot on.
Yeah. There was one more question asking about what is net 30 and 60. I just replied back, but I just want to clarify this part. When you are working with your vendors and you take credit from them, like you say, I will pay in 30, it depends on how credit worthy you are, what kind of history you have with your vendor. Like, sorry, in this case with your supplier. If you are a contractor, you are buying your, supplies or equipment, whatever, from, different sources, you may establish a relationship with that they can extend a credit to you. And it's between you guys, and they can give you a 30 days, 60 days, 90 days, even depending on what kind of working relationship you had with each other and for how long time, because they also do the assessment, risk assessment, how creditworthy you are. And based on that relationship, they extend that credit to you. So it could be 30 days, 60 days. When we say net 30, net 60, net 90, whatever, this is mostly referring to those, type of, credits, which is like extended to you through a supplier. Just making it, that clarification. Let me see, there is one more thing in Q&A. Okay, they said thank you. And I shared the link for our e-library. Generally speaking, we are uploading the recording of the workshops on our e-library. You can find other topics there. So I shared the link. Please feel free to go there.